Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront and generate consistent returns year on year. So the first thing we want to do is open up our brokerage platform. The one that I like to use is Tasty Trade. However, feel free to use whatever you like. And of course we are going to be using options. Specifically, we're going to be writing or selling the contracts. That is our instrument of choice. So we need to know where we are in the options cycle. So you want to just pull up any underlying. Right now we're looking at UAL. This is a live position that we have got on UAL in one of our in this small portfolio. And we just want to open up a list of expirations. And as you can see here, we have weeklies and then monthly expirations. We want to stick with monthly expirations, and we want to be between 30 and 60 days out in time. So if you go down the list, the first monthly is November 15th, which is 23 days away. That is a little bit too close. So we go down to the next one, which is December 20th, and that is 58 days out in time. This expiration, December 20th, is going to be the most suitable for us from the selection that we have to choose from. So now we could take this information, 58 days, and we can come over to our watch list, and we can simply filter out everything that has earnings over the next 58 days. Earnings will increase volatility, it will mess up your deltas, and overall it will have a negative effect on your P&L most likely. So we want to avoid that, and we also want to filter out anything that has a low liquidity level. The reason for that is because we want to be able to get in and out of positions easily, and there's also something called the bid-ask spread. The spread is how the broker it's one of the ways that the broker makes money, and for us, we pay the spread. So it's the difference between the bid and ask. You pay it when you get in, and you pay it when you get out. So the tighter the spread, the less you pay. The wider the spread, the more you pay. So we want tight spreads, and in order for that to happen, we need liquid markets. So we want to, or liquid underlyings even. So we want to remove anything that has a low liquidity level. Now we are presented with a list that looks like this, and we want to order everything from high to low IVR, which is IV rank. And generally speaking, anything with an IV rank of over 50 is considered high, below 50 is considered low. However, there are times when an IV rank of over 30 can be considered high. So now we simply just go down the list and see what would fit well in our portfolio. So just to touch on that, keep in mind what's already in your portfolio and make sure that any new positions you add is going to complement it nicely, meaning don't be too heavy in any one thing. Keep your overall portfolio nice and diverse. If you're very heavy in one sector, go with something else that's not quite correlated, and overall you'll be fine. Just use common sense. You can use correlations with the SPY. You can use beta weighting. There's all this advanced stuff that you can use, and that's fine. That's great. It works. However, if you are just starting out, which I'm assuming you are, just use your common sense and you'll be fine. So we go down the list and we just have a look at what's going on. The actual names, the symbols, the tickers don't really matter too much. We are product indifferent. What matters is the size of the product, the IV rank of the product, and the absolute IV level of the product, as well as the liquidity and a whole bunch of other stuff. But generally speaking, as we're scanning the list, that's what we want to keep our eyes on. So at the top here, we've got anything with a forward slash is futures. SI is silver futures with a lovely IV rank of 92.3. We're not going to go over futures in this video, but we have got TLT here with an IV rank of 78.2 and an absolute IV level of 21.7. If we just have a look at that on the chart, as we can see here, IV rank is shooting up right now, and this is a perfect time to sell some contracts. The reason why we like to sell when volatility is high or when IV rank is high is because volatility is mean reverting. So when it's high, we want to short it and then play the contraction back down to the mean. And right now, we're at 73, between 73 and 79 on the IV rank. And just visually looking at it, we can see that we are very high in comparison to where we have been over the past year or so. So TLT is looking very nice. It's trading at about just under $92. So we should be able to get a respectable premium out of it. And if I remember correctly, it had an absolute IV level of about 21.7% there. So all in all, TLT is generally quite nice to trade. So let's just have a look at TLT. We can go straight to December 20th here. And if we have a look, we've got our horizontal orange bar here that shows you where price currently is with respect to the strikes. And we have a vertical orange bar that shows you what the expected move is of TLT over the next 58 days. So what do we do with this information and how do we profit from it? Well, we need to write some contracts. And we're going to write one call and one put. We've got calls on the left, puts on the right. Where do we want to write them at what strikes? Well, probably we want to be outside of the expected move. That's going to lead to a high probability of profit. And that's good for us. So, as a general rule of thumb, I like to be anywhere between 15 and 20 deltas. Over here on the call side, we've got a 16 delta and a 19 delta. So we've got two to choose from. Because IV rank is looking so nice, I'll be tempted to be slightly aggressive here at the 19 delta. You wouldn't be wrong for even going for the 23 delta, if I'm being completely honest. But just to keep everything mechanical, we can just go with the 19 delta. And on the put side, we can again pick the 19 delta. And as you can see, our contracts are sitting nicely outside of the expected move here. And of course, we wanted a high probability of profit. And in the bottom left corner, we can see we have a 69% probability of profit. Anything over 50 is considered a high probability trade. So this is a very high probability trade. And that's assuming if we held till expiration. But we don't need to hold till expiration, and we can just get out of the position, say, once we hit 50% of max profit. And if we did want to do that, we've got between an 88 and 90% chance of that happening. So very, very, very high probabilities here on this trade. And we would collect $141 upfront in premium, and our broker is going to require just under 1.3k in buying power to open this position. So on a naked position, naked meaning we have an unlimited loss potential, we've got over a 10% return, which is very nice. It's a nice return on capital. And if $1,250 was a little bit too much for you, I'm going to show you how you can manipulate these positions to fit inside any size portfolio. So what we're going to do is we're just going to buy another contract a little bit further out from the one that we're going to sell. So we're going to sell one at 98, and we've got one, and we're going to go $2 down and buy another contract at the 100 strike. So we've created a $2 wide range here for ourselves. And we're going to do the same again on the put side, $2 wide on either side. And what this has simply done is it's limited our loss. So we no longer have an unlimited loss potential. Our loss is limited to the spread, which is $2, minus any premium that we collect, which is 54 cents. And that's how we arrive at our max loss here. And this number here, 54 cents, is to be multiplied by 100 because there's 100 shares per contract. So this is per share, and there's 100 shares per contract. So our max loss is defined by the spread between our short and long contracts minus any premium that we collect on entry. That's how we get our max loss. Our broker knows if our max loss is defined, it only needs to hold that much in buying power to open the position. Therefore, our buying power requirement is basically the same thing as what our max loss is. It's no longer just under 1.3k. It's much more manageable for smaller portfolios. And if you notice, the return on capital is also much higher. However, our probability of profit has decreased slightly. So that is the trade-off when doing something like this. And this is called an iron condor. And that's simply how you can find and manipulate positions to fit inside your portfolio. So there is also another thing you need to keep in mind, and that is the size of your positions, because it doesn't matter what you do, if your sizing is wrong, eventually it won't end well for you. So how do you know how to size your positions relative to your portfolio? And to solve this problem, we've created a spreadsheet. Link is in the description for the spreadsheet. It's free for everyone to use. Click this here, and it will take you to where you need to go to get a copy of this spreadsheet. Like I say, it's free for everyone to get a copy of. And the way it works is you enter in the size of your portfolio. Say if it was $25,000, you then enter in what the current VIX level is. Say if it was 22.3. Below that, everything will then be automatically calculated for you. And at this point, you simply need to use this information to form the backbone of your portfolio. And as long as you do that over the long term, you will be just fine. It will tell you how much buying power you should allocate to undefined and defined risk positions, how much of your portfolio you should allocate to short premium strategies in general. You don't want to use 100% of your portfolio in short premium strategies. There are other lower risk things that you could be doing that can still generate returns, but you shouldn't be using all of your portfolio in short premium. But there you go. That's the spreadsheet. You get an explanation of how it works. And to get a copy of it, like I say, link is in the description. If you want to learn in more detail and you want to see what we're doing in our portfolios, the positions that we're placing, any adjustments that we're making, all in real time, so you can copy if you want to. Link is in the description. Head on over to EDS Premium and get yourself signed up. Inside, you will have access to our portfolios where you can see anything that we're doing, the positions that we're making, and the adjustments, all in real time. There's also a full course inside. So, no prior knowledge is required. We will teach you everything that you need to know from start to finish. It's a private community, so you can ask questions to myself directly and speak with other like-minded individuals. There's a 100% money back guarantee. So once you've studied our full course and followed our trades for at least 6 months, and if at that point you haven't seen results, then we will work with you for free until you do, or you can simply request a full refund. So it's completely risk-free on your part. Right now, it's £1 a month to join. The price will be increasing. However, once you're in, you're in. So you are rewarded for getting in early. The price is locked in. And right now, for the first couple of people that join, we are offering one-on-one complimentary onboarding calls where you'll be able to speak with myself directly and we can go through your portfolio if you have any positions on, and we can just take a look at your position and how what will be best for you moving forwards and how you should structure everything. So take advantage while you can. You definitely are rewarded for getting in early. And with that being said, I will see you guys on the inside.